Morning, everyone. This is Barry Knapp, Ironsides Macroeconomics. This is our inaugural attempt to record both our podcast and a video that we plan to put on YouTube TV under the channel Ironsides Macroeconomics LLC. We will share the screen on a couple of occasions to show you a few of the charts quickly that are contained in our research. We, of course, would love you to subscribe to our research and get all the additional charts, tables that we reference in these podcasts and video recordings. The note this week that we're going to reference in the podcast and the video was titled "Don't Fade the Reopening." It was dated February 20th, and it really is a reference to just how strong business cycle forces are early in an expansion. And there for sure are concerns about policy. The 2009 through 2019 expansion is a great case in point. The only real setbacks we had for the markets early in that expansion were related to policy. 2009, when QE1 was ending, we had the flash crash. In 2011, we had the debt ceiling debate and downgrade, which occurred as QE2 or after QE2 or around the time actually of QE2's ending, and was also, there were fiscal policy problems as well. And that's despite the fact that we had very slow nominal GDP growth, slow corporate revenue growth, slow earnings growth, and still the setbacks were primarily related to policy. So we're going to keep making that point through this expansion, at least the early stages of it, that you really need to keep your eye on the ball around policy. And at this point, although the market is starting to hint at policy problems, we really aren't at the stage where the Fed is going to withdraw a serious amount of liquidity, nor is or have the tax hikes been pulled up in time. We do think we are going to get tax hikes in 2022. They're going to be part of the Build Back America plan that the Biden administration will start focusing on once they get done with the Biden rescue plan. But we doubt that they will be retroactive to the beginning of the year. It seems far more likely that they will begin in 2022 and kick in slowly over time. So our thinking has evolved on that, but we do believe that the tax hike problem is at this point a story for another day. Pardon me. The note began this week with a link to a Wall Street Journal, the lead editorial in the Wall Street Journal on Friday, titled "We'll Have Herd Immunity by April." It's by Marty McCary from Hopkins. And he asserts, pardon me, that we're very close to herd immunity. The reason we've had the 77% drop in COVID reported cases in the last 6 weeks is because we're very close. One calculation we found particularly compelling was to take the total population fatality rate and divide that by the case fatality rate, and you get 65%. This is something we asserted weeks and weeks ago, that the combination of T-cell resistance and serology tests that generally conclude that the number of cases is 6 to 8 times the number of actually diagnosed cases, all would indicate we're well over 50% of the population that has some form of resistance to COVID. And that is the point of McCary's editorial, is that the cases are not falling because of vaccines. They're falling because we are very close to population immunity, and by the beginning of April, we'll effectively be there. So for us, that begs the question about whether there'll be a big consumer behavioral change as we get into spring. We suspect there probably will be, but that'll create some displacement in the markets. For example, we could see a lessening or weakening of demand for goods that was on offer last week with the super strong retail sales number. We'd been arguing that retail sales never really softened late in the year, that there were problems with seasonal adjustment factors. But that notwithstanding, a 5% monthly increase, 6% in the control series is just so strong. It boosted the tracking estimates for first quarter GDP from 4.5% to 9.5%. Remember, not that long ago, there were economists like JP Morgan's, for example, saying that we were going to have negative growth in the first quarter. That's not happening. And so there could be disruption related to this opening, and we think there'll be people that want to fade the reopening. So the first slide we'll share with you here is the cases, and you can see how sharply they're falling at this point. So moving on to to the markets here, we've thrown a massive amount of stimulus at the pandemic. QE has expanded by $2.8 trillion since the expansion got started. $2 trillion of treasuries, $800 billion of mortgage-backed securities. Bank deposit growth has been $3 trillion. If the Biden administration gets the full 1.9, we will have added $5.3 trillion in deficit finance stimulus into the market. There's a 1.14 trillion GDP, nominal GDP gap. That's where we think nominal GDP would have been relative to where it was at the end of the year. There is no earnings gap. Earnings growth is up 4% year on year, looking at the tracking of fourth quarter earnings at this point, with some 80% of the companies having reported. And we're starting to get a significant surge in, obviously, 10-year nominal rates, but also 10-year real rates. And this was a lot of what we wrote about this week, was this move in 10-year real rates. In addition, copper is surging. The Galaxy Crypto Index was up some 15% next week. We're going to write a lot more about this in coming weeks, actually. We have a thesis about what it's going to do. Could the resurgence or emergence of crypto force some sort of a currency alignment over time? It's sort of an early call, but we'll come back to that. Industrial metals prices are surging. All of the cyclical sectors, energy, materials, transports, financials, outperformed the S&P last week significantly. And so you're getting a fairly sharp move in what we've been calling the reflation trade. Others have obviously been calling that as well. The key here with the surge in real rates, though, is to contrast it to the real rate spikes that we saw last cycle. The origins of all this was the 2013 taper tantrum, when Bernanke first started talking about ending the asset purchases, and we got some 130 basis point move in 10-year real rates over the course of a couple of months. But the 2018 moves were interesting as well, when the Fed was contracting their balance sheet. We had a 30 basis point spike in real rates in January of 2018, and that was followed by Volmageddon in February. Again, in September, we had a 30 basis point move in real rates when the Fed reached the caps on their asset purchase runoff for balance sheet contraction. The ECB cut their purchases. They're tapering in half. They went from 30 billion euros a month to 15, and we had that shock higher, and that led to the QT crash. But the big difference between the 28 basis point, now 30 basis point or so move we've seen in real rates over the last few weeks, compared to, and the one that we saw at the beginning of January, relative to those moves in 2018, is this one is a supply shock. It's not driven by demand. Yes, in early January, there were a couple of Fed regional bank presidents that talked about slowing asset purchases in the end of the month, and that exacerbated the move. But the move began with the Georgia Senate elections. The idea we were going to have a blue wave, and we were going to have more deficit financed fiscal spending. And you can see this if you look closely at the TIPS markets, because the 30-year TIPS rate, where the Fed is not really operating. Remember, the average duration of Fed purchases is 6 years, right? So if the 30-year TIPS rate is moving, that's all to do with supply. And that's why we think that this move in real rates here is driven by supply. So supply-driven moves in real rates and moves in rates is reflationary, as opposed to less demand, a big drop in Fed purchases and drops in purchases from other central banks is more disinflationary because they're contracting the monetary base theoretically, and this one's all about expanding the monetary base. So we do think it's an interesting contrast, but nonetheless, a 30 basis point move in 10-year real rates in a short period of time explains why S&Ps are weaker this morning, and it is, a point of concern for us. As we said, we do think people are going to start talking about a fade the reopening move. We think it'll be fairly contained, though, in part because, as we said, this is a reflationary dynamic. Also because the fiscal forces or cyclical forces at this point in the economy are so strong, and because the VIX curve and the implied volatility market in the S&P is priced for some sort of a shock. When we're realizing 6.5% vol on a 10-day trailing basis, the front month VIX option future is 22 or 23%, and 3-month is 29%. The market is priced for a fair bit of risk, and we think that will cushion any down trade. So if we do get a fade the reopening, we think it'll be fairly contained. It should not get to 10%. We think a 10% correction will take the Fed seriously discussing tapering the asset purchases, something that we don't think will happen before June at the earliest. And then if they were to discuss it at June and we had a setback, that would push any tapering till the end of the year at the earliest. So we just think it's too early for that kind of a correction, true policy-related correction. So that's where we are in the broad markets. Moving on to the economic momentum part of the story. We talked about this briefly a little bit earlier in this video and podcast, but go back to 2009 and think about when we had setbacks. We had 4% nominal GDP growth. We had very tepid corporate revenue growth, 4-5%. We had, it's sometimes less, we had 9% on average earnings growth. Typically in the middle of the business cycle, the long-term average for earnings growth is 12.5%. Long-term earnings growth is more like 6 or 7, but if you remove recessions and look at the middle of the cycle, it's more like 12.5. Last cycle was below because of that tepid nominal GDP growth. Even with that, the setbacks that we had early in the business cycle for the markets, 2010's flash crash was related to QE1. 2011, we had the debt ceiling debate and downgrade. That was related to the end of QE2. 2012, we had a pullback when Operation Twist was going to wind down, and then the Fed ended up launching QE3, extending Operation Twist and launching QE3. So they were all policy related. That for us is a key message. But if you look at the incoming data, even last week, 6% core retail sales numbers that push that GDP tracking estimate from 4.5 to 9.5. The strength of the PPI numbers, import prices being strong, the flash PMIs in all the big manufacturing countries around the world, and US being close to 60. This is a lot of economic momentum. And as we've been arguing, the recovery in the labor market is coming from, the recovery in the manufacturing sector is coming from the trade war plus the pandemic. And to add to that, we would note that there's some concern that we've heard about manufacturing margins coming under pressure because prices paid is moving more sharply than prices received. And we can show you this chart quickly. And so you can see what tends to happen is, there it is. What you can see is the blue line, which is prices paid, does tend to move more sharply than prices received for manufacturers early in the business cycle, and then corporate margins lag that. But we think that this really is all about just the cycle and the timing of the cycle. So yes, prices paid go up first, and then prices received go up, and then corporate margins go up, and then capital spending goes up. So it's just more of a cycle dynamic than it is describing how margins are going to come under some sort of pressure. And to add to that, we would note that R&D expense has rebounded much more quickly than we would have expected. It rebounded in the fourth quarter. Now it's been concentrated in technology sectors, communication services, healthcare. Those are the sectors that you would expect because of the nature of the pandemic. But we think in the first quarter, we'll see R&D expense broadening out to other sectors. And we think capital spending from a bottoms up perspective will broaden out as well. And that'll be a big part of the US specific story that'll be so robust in 2021 is the recovery in capital spending. So those are powerful forces that we think will offset any short-dated concerns about rising real rates and the effect of massive supply of treasuries putting pressure on real rates. And we think the markets will be just fine after what could be a little bit of a pullback here. But as we said, don't fade the reopening. We did add a few almost throwaway comments on the GameStop hearing last week. We got forced to listen to an hour of it fairly intently as we were on hold for power lunch at CNBC, and they were hoping to cut away and ask us about the market. And Congress people just kept bloviating about this and not really getting at the real points. We thought there were a couple of interesting things, though, to note on this. One is we didn't think the way the questions around short interest and Reg SHO, how much of the float of GameStop was supposedly short relative to shares outstanding. We didn't think those were answered sufficiently. We have a lot of sensitivity to this going back to our Lehman Brothers days when it appeared that there were people short without true locates. And we do think the SEC is going to need to tighten up those rules around how much stock can be short, not the disclosure stuff. We don't understand why a short should disclose their positions more than a long should. That should be pretty homogeneous, but just the technical aspects of locating a short. The other thing that we were a little struck by is we've been writing a little bit about how we thought that antitrust policy was going to move away from Robert Bork's consumerism to the broader lens of structuralism. Just if you have massive market share, you have the ability to control things. And while we're not casting any real normative statement about whether it should be structuralism or consumerism, we were a little bit surprised that when Citadel's CEO said that they had 40% of retail flow market share, that nobody kind of went, 40%? That seems like a lot. And why should you have that much market share? And start examining why all the post-financial crisis regulatory policy pushed the street out of that business. Our own firm, Barclays, had huge market share at New York Stock Exchange, specialist systems and the like. And it got all pushed out to Citadel and other players. And we're a little surprised nobody asked any questions about that. But anyway, that notwithstanding, we don't think there's any big market implications. As we said, for our part, we think the whole GameStop lesson is you shouldn't be short low quality stocks at the beginning of a business cycle. You're just doomed to get crushed on your short positions, like what happened in 2003 and 2009. So that's it for me this week. Hopefully this video looks okay and the podcast will sound good, and we can create both of these every Monday morning and get them out to all you guys, and you'll all consider becoming a subscriber to the actual written research, which is our marquee product and where we put our most time and effort at the end of every week. So have a good week, everyone. And we will talk to you again in a week's time. Thanks.